have a couple positions short in crypto right now, and I do have a little Bitcoin on the long side as well. So I'm a little hedged. I'm kind of short alts right now versus being slightly long Bitcoin. But the key is this, is it's a very, very small, very, very small position. And what I want people to understand is that you can still accumulate in this lower range. I'm still a huge long-time bull or long-term bull on Bitcoin. I still think it's going much, much higher than even 69,000. It's just you have to give it enough time to kind of digest what the Fed is doing and kind of cycle out all the weak hands. So again, for me, it's just going to be continuing to accumulate. We get to 15, we get to 13, we get to 10, to 5. I will continue to kind of accumulate with a long-term view, but I'm not going to be someone that's chasing it at 25,000 on a pop here.
Gareth Soloway is a well-known expert in the fields of macroeconomic analysis, technical chart analysis, and providing alerts for trade signals. In this video, Gareth Soloway gave his outlook on stock, gold, Bitcoin, and global economy. Gareth Soloway believes that investing in Bitcoin and other cryptocurrencies can be seen as a speculative endeavor. But for those who believe in the potential of these digital assets, purchasing Bitcoin during a recessionary period could present an opportunity for significant returns in the future. According to Soloway, in 2023, policymakers are taking a different approach by increasing rates at a slower and more deliberate pace. To beat inflation, several other countries also lifted interest rates. This has adversely affected the global growth outlook and raised fears of a recession. Fed officials have indicated their inclination towards implementing additional rate hikes until they are able to effectively address and reduce inflation to desired levels. It is said that the ultimate level of interest rates is likely to be higher than previously anticipated. Before proceeding further in this video, please make sure to click on the subscribe button below to stay updated with our latest content.
To me, the recession is going to be a slow rolling recession. It's going to be one like the lobster in the hot water. And I hate to use that kind of imagery, but ultimately where it slowly heats up. And I think initially people are going to say, okay, it's not really going to be that bad. And the Fed probably calms us down by saying, oh, it's not going to be that bad, just like they said it was going to be transitory on inflation. So they have a tendency to understate what's going to ultimately happen, and investors have to be prepared on the other side for something much, much worse. But because it's going to last so long, it's going to continually get worse and worse and worse. But the Fed is unlikely to come to the rescue, at least for the first 12 months of this recession, due to inflation's high levels. So that's going to make it, by the end of this recession, it is going to be nasty. And I think we could be, and I said this before with you as well, I'm looking at no new highs on the S&P 500 for 10 to 15 years. I think that we're in a recessionary period for at minimum 2 to 3 years, and it could even be dragged out longer. Eventually, unemployment goes so high that even if inflation is 3%, the Fed will come to the rescue eventually and stimulate. And again, I'm talking unemployment could be north of 8 to 10%, and then they're going to be forced to stimulate to kind of bring that down.
Gareth highlights that if the S&P 500 falls below the 3,900 mark, it could trigger additional selling, potentially causing it to drop to the critical 3,800 level, where we saw a rebound in the past. Despite the market's ongoing volatility, Soloway acknowledged that the flexible mindset of fundamental traders and technical traders can be somewhat challenging to navigate. The 4,200 level being broken to the upside could be a very bullish sign, but it seems like it's almost impossible to happen in this environment. According to Gareth, we see that the 2023 lows run right around 3,800, while the 2023 highs apex right around 4,200. Focusing on the S&P 500, the index managed to recapture the 4,000 level in the morning trade, but is moving without strong conviction on Thursday as traders avoid taking large directional positions ahead.
So let's go back to the S&P 500 and take a look here. So what we see here is that you're in this wedge pattern. If we were to break above this wedge pattern, you'd have to assume this is the beginning of a move up. It doesn't mean we're going back to all-time highs, but we're likely going up to this 4320 level on the S&P 500. So really, once you're above this yellow trend line, that would be where you would say, okay, you now have to exercise that mental stop or physical stop and exit the position. But right now, again, notice we're having a nice little down day. We're hammering on this trend line. If this trend line breaks, this is where the next leg lower should kick in. And ultimately, I think I still have it pinned in that we're going down to pre-COVID levels on the S&P 500. That's around 3375 and potentially as low as 33,000 on the S&P. You don't have the government sending out checks. You don't have interest rates at zero. You don't have massive quantitative easing. And so you're getting these kind of buy the dip mentalities of coming back in, hoping that the bottom is in. The problem is, and by the way, the bottom being in is being driven by a narrative that the Fed is getting close to halting their hikes. and actually lowering rates. I disagree with that. I think they are getting close to the end of the rate hike cycle. I just don't think that they're ready to lower rates, especially with some of the inflation data that we've seen recently. So we'll probably see a 25 basis point hike in the next couple of weeks from the Fed when they have their, I think it's March 22nd meeting. But ultimately, the big kicker here is that you're going to see 5% interest rates for a long period of time. The Fed has made it clear they don't want to repeat the issues that Paul Volcker met in the 80s, and that's going to be what's going to really drive the economy into a recession.
Gareth predicted a recession expected in the second half of 2023 is projected to have a significant impact on global information technology spending for the year. According to Soloway, expectations of more interest rate hikes from the U.S. Federal Reserve have increased following the recent hawkish comments from the central bank and the release of upbeat economic data. In the World Economic Outlook published in January, the IMF predicted that global growth is projected to fall in 2023 and many economies would experience a recession this year. At the same time, expectations of rate cuts have also come down, with traders now pricing in less than 15 basis points of rate cuts in 2023, from almost 60 basis points a month ago.
We've been addicted. It's an economy, an investable market that's been addicted to interest rates. In fact, it's so crazy. Like if you talk to economists, if you talk to investors, what do they say? They say, oh, don't worry. If we go into a recession, the Federal Reserve will print money to get us out. Think about that statement. You're basically saying that the economy can't get us out of a recession by itself without the help of printing of money. And that's ludicrous, but that's the situation that we're in right now. So you have to be on the awareness side that at this stage, the Fed is going to be very nervous. They've been bitten by the inflation bug. Remember, they said transitory. It was anything but transitory. And that's going to make it a situation where they're going to be very reluctant to lower rates unless inflation goes below 2%. And I don't have that penciled in for multiple years. So what is that going to mean? It's going to mean we're going to slip into a recession. Essentially, they're not going to lower rates to get us out. They're not going to print money to get us out for a longer period of time. And that puts us in a potential recessionary period for 2 to 3 years at minimum. There is a tidal wave coming that should hit in the next 3 to 6 months that I do say, I will go on record and say, second half of 2023, we will see the recession hit.
As of the beginning of 2023, there has been a reversal in trend, resulting in gold prices rising by nearly 10% from October 2022. As noted by the German firm, however, in subsequent recessions, the gold price has fallen less and recovered more quickly than the other metals. The gold price tends to be slightly higher at the end of a recession than at the start. Markets could remain volatile in 2023 due to concerns of recession and interest rate hikes, potentially leading to a surge in gold prices up to $4,000 per ounce.
I know in our December meet, we talked about how I still think gold will be the best performer in 2023 when comparing the S&P and Bitcoin, and it's having a beautiful pullback today. I started to nibble again on some gold opportunities here. I do expect by year end for us to at least retest the highs on gold. So there are opportunities. And again, I think people have to just be very, very careful. This is not a market to really put all your money in. You want to leave some dry powder on the side so that you can actually react when the opportunities pop up. I do think that we'll be north of 5,000 an ounce within about 3 years as the bear market takes hold, as inflation doesn't get back in the box under.
With everything that we've seen over the past 2 weeks or so, traders and market participants are confused as to what to expect from the economy in 2023. That's all about Today Analysis. What do you think of Gareth Soloway's predictions for gold and cryptocurrencies performance in 2023? Do you agree or disagree with his outlook, and why? Share your thoughts in the comments section below. If you found this information helpful, please consider giving this video a thumbs up and subscribe to our channel. We look forward to bringing you more updates in the future.